Welcome to the third stock on my list, Ulta Beauty, ULTA. So why Ulta? Well, it fits the technical parameters for one. So I mean, for example, it has high premium in the options. It's a really expensive stock. It's currently trading about $351 a share. But more than that, it is one of my favorite hot stocks within the retail space. It's defying the retail apocalypse. It's really one of the only makeup stores. I mean, there is Sephora, but it's really the only one that continues to grow on a quarter-over-quarter, year-over-year basis. It's very popular with millennials, which means that it's going to continue to have money coming to it for years to come, of course, as long as they still keep doing the same thing. So why does it make sense to sell passive income on Ulta? So on this next slide, we are going to talk about the trend. When you look at Ulta on a daily chart, this is a daily chart, you want to just eyeball the trend. Looking at it right here, you can see that for the first half of the year, it was pretty consistent, trending higher. So obviously during this time frame, just selling regular put credit spreads made a whole lot of sense. Why was it trending upwards? Well, you can see the way that it respects the 8 EMA, and there are a couple different times where it will dip to 21 or even the 34, but it's immediately bought. Now, something made a little bit of a change here in May, and as we all know, May was a little bit tricky in the stock market because of all of the tariff threats. And so throughout the month of May, it was difficult for most stocks, but that also made it a good time to sell premium, both on the upside and on the downside. So in that one instance where you can see the trend shift, the trend strength candles shift from green to yellow to red, and then they break down below the major moving averages, that is a trend shift. Now, as of right about here, halfway through June, we went back into a bullish trend, and at that point, selling put credit spreads again would be the best plan. So let's go ahead and look at the spreadsheet. When we're looking at the spreadsheet, what we want to do, we want to type in the current stock price, implied volatility, expiration date. Now in this instance, I did it about 10 days out, but you could also do it a little bit further, about 17 days out. So some of these aren't going to have as much premium. And when you can see that it doesn't have as much premium, you have the option to adjust your days till expiration. You can also adjust your strike increment. And then you can adjust this number right here. So I'm going to do it just the base method with 1.5, 2 standard deviations with your range. So like we discussed with the previous two, you have 1 standard deviation, 1.5, and 2 standard deviations. And there's going to be different times in the market where some of these, a 1 standard deviation move might get you a great credit, and a 1 standard deviation move might not. So right now with Ulta, for whatever reason, it only has 23% implied volatility. And so when I put this in here, per the parameters, the credit is only 35 cents. So for me, for a $5 wide spread, 35 cents is about half of what I'm looking for. I really want to be able to get about 60 to 70 cents. And so I look at that and I say, I don't really think that that's really worth it. So what should I do? Well, number one, the most obvious thing that you can do is just pass on it. You don't do anything with it. You just say, that the IV is too low right now for whatever reason. So I'm going to pass on this. I'm not going to make a trade on it. Or what you can do is you can really try to narrow down your entry, and you can try to maximize the entry, therefore maximizing your probability. So one option here is timing your entry with a pullback to the 50 period simple. For me, especially with this type of premium selling strategy, and if you look at the 50 period simple, you can see, like we already talked about this here, you're at your 50 here, 21, almost at your 50, 50, yes, right here it did break down, but here you're all at your 50, and right here you're almost at your 50. So I feel like the 50 period simple is a pretty good, that's supposed to be SMA. That's a pretty good intermediary, okay? So that's one thing that you can do, is just focus on that. The next piece of that is when you have, a directional setup for example, if you have a squeeze, if you have a fib setup, if you have some reason to believe that the stock is going to trade higher, then what you can do is instead of doing one standard deviation, you can do a half deviation, or you can do the at the money spread. So of course, as we know, the at the money spread is going to be the 5-star strategy. Or, if you're really elevating it, you can do a butterfly, because in these type of instances, you could probably get a pretty cheap fly. So looking at the options as far as a half standard deviation, what you're looking at here for a $5 wide spread is going to be about 85 cents. Now, if that was for one standard deviation, it would be a much better credit. For a half standard deviation, it's kind of like, yes, if you're doing it on a pullback, I think it's fine. You just need to keep your alerts up and ready. Make sure you're paying attention to what's going on. But overall, the 85 cent is pretty good. Of course, my favorite is going into the 5-star, but as you can see with a 5-star, even in this instance where you're at the money, when you're at the money, you should be getting around a 1-to-1 risk reward. Yes, there are going to be times where it's 2-to-1 if the IV is low, and this just happens to be one of those times. So that is something that you need to pay attention to. And right now, looking at the 15 or I guess 17 days till expiration, you are getting less than a 1-to-1 risk reward, but that would be your third option. Your most obvious option, obviously, is just to say, hey, you know what? That's not okay with me, and let's look at the next stock. So what is the next stock on our list? It is ServiceNow. So let's go ahead and check it out.